And first of all, thanks very much to the organizers for bringing everybody together on this. My name is Jan Cieński. I'm the Financial Times correspondent here in Warsaw. The discussion, we brought together people who have both a macroeconomic perspective, who have a close idea of what's happening in the banking sector, and then people who have a very good idea of what's happening in real estate overall. So we're going to sort of conduct it as a fairly loose conversation about what's happening in Europe, how that filters into what's happening in Poland, and how that overflows into the real estate sector. And there will be time for questions and discussion as well, so that everybody has time to participate. I think the interesting thing what we see at the moment for Poland, when I've been looking at the macro Polish story, is how surprisingly good it is. Every week or two, we get a data release of some kind, whether it's unemployment or industrial production or GDP growth for the quarter, and every single data set seems to surprise analysts on the upside. They keep waiting for the slowdown in Western Europe to kick in and start to affect Poland, and last year it didn't. The expectation is that this year it will. So that's been very interesting to see if that, in fact, does start to happen. But again, the internal demand continues to be fairly strong in Poland. The exports are still doing surprisingly well, considering the general slowdown in the Eurozone. I think some of the things that we'll see this year that could have a big impact on the real estate market, first of all, is what's happening in banks as they are forced to increase their capital. We're going to see a tightening in lending, and there's going to be a knock-on effect across the economy, and particularly, I think, in the real estate sector. And I think that real estate tends to be a sector that feels any kind of a change in the weather very early. It's essentially a barometer. We certainly saw that in 2007 and 2008 when the sector started feeling signs of a chill long before other sectors in the economy. And so hopefully we'll see if that looks to be the case for 2012. As a representative of our hosts today, DTZ, I'd like to ask Magali Marton if she could give us an idea of whether this potential chill in the macro environment, if that's going to overflow at all into the real estate sector. It's a general question. If you see that happening in 2012.
What I would like to do, just as an introduction, is to share with you what we have seen in terms of market trends in Europe, and especially with a focus for the Polish investment market. Of course, we have been last year in a mixed situation with some very good trend in terms of investment volume on the core market, like in UK, Germany, France, but also in the Nordics country. For the moment, CE region and the Polish market is slightly below this very good and dynamic trend in terms of globalization of the market, with an increasing market share for cross-border investment. So it means that regarding the Poland market, we have reached a volume of 2.6 billion euro invested in commercial real estate last year. So it means that we are still below the record level, close to 5 billion we have seen in 2006, 7, something like that. So it means that we are in a good trend in the Polish market, but we know that we have some room to improve and to see volume of investment increase in the future. What is interesting regarding what's happened in Poland in terms of investment trend, and I have checked all the major deals we have registered last year, and you can find all the major players active in the local market, which is also a good sign. We know that some very major players like Unibail-Rodamco, Blackstone, Invesco, Atrium, all the big names of the industry are active on the market, which is something to point out. Of course, we know that the focus of the investor today is really to identify where is some capital growth in Europe. And we know that the European market is reducing by the time, and with some negative news we have heard regarding macroeconomic trend in the south part of Europe. We know that now the risk is spread across Europe and include some major economy like Italy, like the French economy also. So it means that in terms of risk perception by the major investors, they will probably refocus their attention to CEE markets where there is, and you say that as an introduction, very good numbers in terms of macroeconomic and well above the European trend. So it means that if you, as a first, as a starting point in terms of geographical allocation of your money to invest in commercial real estate market, if you just have a look at the figures on macroeconomic trends, CEE and the Polish economy is in a good position to attract capital flows. After that, you have to have a look at the size of the market, and we know that in terms of population, Poland is probably one of the most interesting markets in the eastern part of Europe. And we know that in terms of rental growth, capital growth in the future, I would say that the Polish market is not better or not worse than other countries in Europe, but we can expect some growth in the future, which is another very positive sign. And of course, after that, it's just a question of identify the good opportunity of the market, if this opportunity is available, of course. And we know that one of the very interesting trends in European investment market today is a clear focus of investors on retail sector. And once again, I think that the Polish market is quite interesting at this level. We know that we have more or less, let's say, 11 million of square meters of retail space on an existing stock at the moment in the country. We know that the pipeline is huge, with probably a refocus from major city to small or medium-sized city. So it means that there will be products coming on the market, and we know that it will probably take some time to attract capital flows and investors and convince them that it's really a good place to invest money. But I would say that on the economic trend, on the real estate trend, the Polish market has a good chance to see more and more capital flows coming to the country.
Thanks very much. I'd like to ask Jakub Borowski, who's the chief economist for Kredyt Bank, do you see how do you see Poland doing in a macro sense in 2012? I mean, the European Commission foresees growth. The general consensus seems to be that growth will slow slightly this year to about 2.5%. What's your view on what 2012 will look like overall for the Polish economy?
I think I would start by answering your, let's say, teasing question at the beginning of the session. So you said that we are still surprised by the economy, and it's probably good to start with some explanation why we are surprised. I think if you look at the number of business indicators or soft indicators, most of them, if not all, point to the slowdown. So if you look at the business indicators provided by the Central Statistical Office, National Bank of Poland, even PMI, with some differences within the PMI, because some let's say sub-indices still point to relatively high growth. For instance, new export orders are surprising us, but again, the picture is pretty consistent. So then the question is why there is no slowdown or substantial slowdown in the real data. I think the mixture of factors is behind it. The most important one was first the exchange rate depreciation that was really heavy at the end of the year, 2011. And we see in the business indicators that it affected positively export performance. This effect will certainly fade, but it's here. That's the first thing. And second thing, these are the seasonal factors, particularly very mild winter in December and also in most of the January. most of January. So we saw it in the data on construction. However, if you look at the data on industrial production, with some seasonal adjustment, factoring in the number of working days, you see a sign of a, let's say, a moderate slowdown. So my story for Poland, let's say very short-term one, is that the slowdown will be here, but it will not be a substantial thing. And what we are expecting is basically the soft landing. Our forecast for this year is 2.8 of growth, which is somewhat higher than what the government expects, but basically in line with the consensus. And then, of course, what is the most interesting thing is the structure of growth. So, well, definitely the positive contribution of net exports. Imports are likely to slow down at a faster pace than exports. Then consumption is likely to slow down visibly, and it already slowed down in the fourth quarter because we may derive it from the first estimate of the annual growth, which was provided by the Central Statistical Office. And then I think the most complicated story is with investment, and this relates somehow to the theme of our today's meeting. A part of this investment story is quite easy to, let's say, outline. This is the story related to the public investment. We more or less know what the government will do. The government wants to cut down public investment substantially in the second half of the year. Why second half? Of course, because we have Euro 2012, and this is an important deadline, and we also see it in the data on construction. But also there are, let's say, the reasons behind it are also linked to the problem of debt sustainability. We know that the government has an ambitious program to stabilize the debt to GDP ratio and then to lower it. And also a part of this program will be, let's say, delivered by municipalities, so particularly big cities. If we look at the budget of Warsaw, we see that the investments are likely to fall by more than 10% this year. So public investment will go down, and will go down in the second half of the year. I think that's our story for public investment. And then we have the private investment, so the investment delivered by enterprises. And here, so far let's say we were surprised, because what we are seeing is that the dynamics of private investment was rising over consecutive quarters of 2011, reaching the top in the fourth quarter. But then we have to sort of confront it with the data, with the business indicators, and they clearly point to the deceleration in private investment. And the indicator I look at, which I find very interesting, is the information whether the investment that have already started are going to be in new projects, so let's say increasing the production capacity, or the improvement of existing capacity, so modernization, whatever it's called. And it seems that according to the data that we have, we don't have the data for the fourth quarter, but we have for the first 3 quarters. Generally, enterprises are focusing on modernization rather than new investment. So in that sense, we are not expecting a boom, an investment boom in the country, because by a boom, we mean new investment, so new capacity. Why are they so reluctant to invest in new capacity? I think that basically uncertainty about the future demand, the evolution of the debt crisis in Europe, and also relatively, let's say, very moderate recovery or stagnation. Basically, this is what people expect. Even yesterday, we had the PMI data on Euro area, Germany, and France, basically pointing to the risk of mild recession in Euro area already. So that's basically our story for this year. I would say pretty optimistic, with large uncertainty regarding investment, Consumption slowing down, positive net exports, again, soft landing.
Great, thanks very much. Ben Habib, who's the CEO of First Property Group, is out on the front lines, buying, selling, has a very good feel for what's actually happening on the ground in the real estate sector. And I'm wondering, do you see Poland potentially being a safe haven from the stagnation and turmoil in the Eurozone? Is that a story which is at all penetrated into Western Europe, or is there a general sense that Central Europe is a fairly risky area, that people conflate whatever things are happening in Hungary with Poland, and there's just a wariness and aversion to getting involved in this part of the world? And how are you seeing that in terms of investing in the real estate sector?
Well, it's a very interesting question, Jan. If I can go back a bit before I answer your question, I think to some extent, when Western Europeans like me come to Poland, we're coming here partly because we're attracted by the Polish story, but partly because we see our own domestic markets as not being particularly attractive. So it's a bit of push out of our own markets and a bit of pull into Poland. And in a sense, that's that could be called the part of the carry trade. It's not how the carry trade term is applied, but the fact is we're getting out of moribund, low growth, low interest rate Western economies and looking for more interesting places to invest our money. And that was what brought us to Poland back in 2005. It was a long time before the carry trade became attractive, but we could see that the Polish story was a much better one back in 2005 than the British story, and that continues to be the case. I think what's happened in the last 6 months has clearly had an adverse effect on Poland, and it is going to weigh Poland down going forward. But notwithstanding that, Poland does present itself as at least in my opinion, a much better investment proposition than Western Europe. However, what we do see, and what is symptomatic of the way our financial institutions work in Western Europe and the United States, is that we're either risk on, it's not an expression I like much, but we're either risk on or we're risk off. And if there's some bad news out of the European Union, we're risk off. If there's a bit of good news out of the European Union, however transient and unbelievable it might be, we're risk on. And you see that play out in the zloty exchange rate on a sort of daily, weekly and monthly basis. At the moment, I'd say that the basic trade between Europe and Poland, I'm not talking about the property market, I'm just talking about general investment sentiment, is risk on, and that's exemplified by the zloty having strengthened from about 450 in December to 420 at the moment. Just coming to the property market, which is where your question was focused, we became, as a firm, naturally we became very cautious in 2009. We believed in the macro picture for Poland. We continue to believe in the macro picture. But as a property investor, you also have to have an eye, naturally, on where values are going. So even though you think that tenants are doing well, rents are likely to be sustainable, yields are high, you have to have one eye on where investment yields are going, and therefore what the value of property is doing when you're making your investment. And 2009, we believed in the macro picture, but we were nervous of what was going to happen to the banking sector and what might therefore happen to values. The other nervousness we had in 2009, which has come back to the fore with a vengeance, and it's something that the FT, for example, hasn't really commented on. There's been a lot of comment on the foreign currency mortgages taken by residents in Poland, but no one's really commented on the fact that the commercial property investment market in Poland trades in euros, whereas the underlying currency that tenants earn their money in is zloty. And that is a quasi It's not a quasi. It is a direct foreign currency risk. And when I spoke to people when I first came to Poland, they'd say, well, it's the tenant who takes the risk. As an investor, you're getting euros, you can relax. And that's true to a point, but it's only true for as long as the zloty-euro exchange rate is not hugely volatile. Now, in 2008, we had a fantastic run with the zloty when it went down to 3.20 against the euro. Rents were set at very high levels on the back of it because tenants could afford very high rents. And in 2009, we got the shock of our lives, the first shock of our lives, when the euro went to 4.95 zlotys against the euro. And we were reminded of it again in the last, just as we were beginning to get sanguine, beginning to think, we could invest more confidently, we were reminded again about the stark risk that exchange rate presents. And it is interesting that a lot of the transactions last year were in the retail sector. Blackstone were a very significant part of it. But of course it's the retail sector, it's the retail tenants who are going to be most immediately affected by a weakening zloty. Rent as a proportion of a retailer's cost is a very high percentage, much more so than of an office tenant. And so when the zloty weakens, a retail tenant will feel that very quickly. And I think it's simply too early to tell at the moment where the retail market in Poland is going in view of what happened in the last half of last year. I think it's very positive. So I've got an opportunity to slag off politicians, so I'm not going to miss the opportunity. We had intellectually concluded that Western European governments would hold interest rates down, there would be quantitative easing, that quantitative easing would manifest itself in money coming into Poland and other emerging economies. What we hadn't banked on was the ineptitude of the European setup to get its act together and deal with the monetary crisis in the way that the Americans and the British have. And we hadn't factored in our own thinking at all the paralysis that Merkel, I don't think it's Sarkozy, I think he would have printed money, given the first opportunity he would have printed money, but the paralysis that Merkel virtually brought the banking market to. I was speaking to banks, a number of banks present here today, speaking to banks in November, December last year, and there was just no euros available in the Polish banking market. You couldn't get a euro note. To all intents and purposes, the euro ceased to function in Poland in the last quarter of last year. And that is a stark reminder of the risk that Poland faces, the investment market risk that Poland faces, given that its market trades in euros and the underlying tenants pay in zlotys. So to answer your question, I think it's too early to tell what effect all of that is going to have on the market. None of it is positive, I'm afraid to report. It is encouraging that the zloty has recovered. It is encouraging that the ECB did eventually, and I suspect they printed the money, produce 489 billion euros worth of cash at the end of December. If the FT is to be believed, and I do believe the FT, there's going to be another €1 trillion of cash injected into European banks this month. That will flow into Poland, and I expect the zloty to strengthen on the back of that. So I think that the 2012 picture looks reasonably positive as a result of all of that. But when you buy a property, you're not buying it for a 12-month view. You're really buying it for a 5-6 year view. And so I'm probably rabbiting it on too much. But the other elephant in the room, which we haven't touched on so far at least, is the EU cohesion policy. And from a property buyer's perspective, we need to look at 2014, 2015, 2016. And so far, Poland has benefited from, I think it's been the largest beneficiary of the EU cohesion policy. And it's received 67 billion euros, or it would have received 67 billion euros between 2007 and 2013, which equates to roughly 10 billion euros a year on average. Now, in 2007, Poland received 3.5 billion euros from the EU, and economic commentators equated that to about somewhere between 0.6% and 0.9% of GDP growth. So you could, using that sort of yardstick, you'd be expecting the EU cohesion policy alone to be contributing somewhere between 1.5% and 2% of Poland's growth. And that is going to end at the end of 2013. So what happens to the Polish economy when the EU cohesion policy comes to an end, when that 67 billion has been dispersed, and the EU is in no mood to give money away easily anymore? That's gone. So we have to face up to what's happening in 2014. So I think we're living basically in a time of great uncertainty. As property investors, we have to look at the long term, and we as a firm are therefore, behaving very, very safely at the moment.
On the cohesion fund, I mean, when I talk to Polish government officials, they're convinced that the next budget cycle will still be a good one for Poland. That the one after that, Poland will be too wealthy, and the EU's approach to structural funds will have changed. But assuming that there is still a functioning EU in 2014, which looks very likely, that their expectation is that they'll get about as much, at least as much as they got for the last budget cycle. So 67 to 80 billion euros in that range for the next 7-year cycle. Yeah. But that'll be the last big one. After that, it'll be much.
I have to say, in view of what's happened in the last 6 months, I'm not privy to the discussions, obviously, that they've had, but it seems optimistic that they'll get that. The mood in Europe is, Eastern Europe's got a hell of a lot of our money. We've been propping this place up. We've got peripheral states down to the south who've been mopping up all our cash. It's time to concentrate on our own populations. We're going to keep cash for ourselves. And I think it's going to be a hard call to... Because I think the EU cohesion policy in total was about 364 billion euros. And to print another cheque for 360 odd billion euros in 2014, in view of where we are in the economic cycle now, it just seems like a very tall order to me.
We'll see. I mean, I'm relatively optimistic that they'll get... There's not going to be a cutoff. I mean, they'll have to give something. So we'll see how that goes. So another area that hasn't really come up yet in the discussion is, and was fairly crucial both on the development side and on the investment side, is what banks are doing, and whether all indications are when you read the surveys conducted by the National Bank of Poland that banks are tightening up on lending, and they expect to continue tightening through the course of 2012. And so I'd like to turn to the person who's in a way applying the screws to the banking sector, and maybe get a sense of what the KNF's view is of banking lending, and how you see the sector reacting to demands to beef up their capital over both in the Eurozone and in Poland.
Thank you very much for giving the floor. In the beginning, I would say that don't overestimate our role, but nevertheless is important. Well, let me turn to your question on the overall impact of the economic slowdown to our economy, and in particular to the banking sector, because I think that what we said here is, first of all, that both our economy and banking sector have been pretty resilient to the adverse scenarios and financial crisis since the beginning, since 2008. But, however, I think that, and of course, we see that it's going to be a soft landing and rather limited impact in case of mild recession. But the question is for me, how severe is going to be recession in the Eurozone, and how long it's going to last? Because I think that in order to answer to these questions, we have to think first of all whether the Euro area countries will be able to to provide or reverse confidence in the confidence to rebuild confidence between international investors and politicians and the countries, peripheral countries, and it requires, of course, money, and it's not so easy. And secondly, the recession will depend on the adjustment programs, austerity adjustment programs, consolidation of fiscal situation, and also structural reforms. And this, of course, lasts, and in fact, we don't know the final outcome, how it will be translated into accelerating of GDP growth and taking out those peripheral countries out of recession. So I think that in case of mild, say, recession, so the impact on Polish economy will be limited because, and on our Polish banking sector, because our banking sector is not directly exposed to the sovereign debt of Euro area periphery countries, and from this point of view is very resilient to adverse shocks. On the other hand, I think that we are much more connected with our main trading partner, that means Germany. And in fact, what is the most interesting and crucial for us is the development of economic situation in Germany. Less important that is the development of situation in Euro area periphery countries, provided that it's going to be disorderly default of Greece or some very strong severe scenario. But coming back to the situation of the banking sector, so I must say that at this very moment it's pretty robust and it remains pretty stable. Banking sector has pretty strong capital base. The current adequacy ratio at this moment is at the level of 13%. And of course the profitability of our banking sector has been growing since 2009. And of course the propensity to retain these profits within banks to increase capital base is growing, following the Polish Financial Supervisor Authority recommendations. So that is also very important. In terms of liquidity, I think that the liquidity position of the banking sector is also pretty stable, apart from few banks that they've got problem with currency mismatches. But nevertheless, it's important in terms of liquidity. I think that that's reasonably low confidence among the banks to loan and deposit money on the interbank money markets. So I think that is not justified by current situation and spending of banking sector, but the confidence is pretty low as concerns the interbank money market. So in terms of risk, so I think that what we said here, that the market risk is the most significant at this very moment, and that is because of exchange rate volatility affecting both liquidity and profitability of our banking sector. Profitability through the profit and loss account, because in case of volatility there is need to build high provisions on impaired assets, and also through the higher risk-weighted asset denominated in Polish zlotys that diminish the capital base. So, in terms of credit growth, what is probably most important for you, in particular housing loans, so I think that the pace of credit growth remains, overall speaking, pretty moderate, both in corporate sector, housing, but at this moment, and also individual entrepreneurs. The NPL ratios are increased vulnerability significantly in 2009, 2000, and it still poses some risk to the banking sector. And for the non-financial sector, the non-performing loans ratio is at the level of 8.3%. Right now, for households, 7.2% at this moment. But apart from a market risk, I think that what is important is the growing also the credit risk is the main area of concerns, and that is mostly because of worsening of housing credit portfolio. And so at this moment we see the growing share of mortgage loans with LTV over 80%, which is recognized by Basel committees, the loans with heightened risk in newly granted credits. That is over 80%, that is 50% of newly granted credits. And also the existing stock, which, as you know, that just between 2006 2008 were growing very rapidly. I'm talking about housing loans. So the existing stocks at this very moment with LTV over 100% is around 1/3 of total portfolio at this moment. So the situation is worsening. So another phenomenon is also the excessive product concentration in certain banks. Certain banks rely too much on housing, the profits from housing loans, and also this is the area of concerns. And another issue which should be recognized in terms of risk is also the FX loans. That is what was said. That is, we talking later probably about the instruments that we introduced to diminish the market risks associated with FX housing loans. However, these are not only our, let's say, instrument, macro and micro prudential instrument, but these are also introduced by the European, or recommended by the European Systemic Risk Board to all EU countries. I'll stop on this. So the situation, I think the banking sector remains pretty strong. Talking about the recent credit surveys, so that is true that for the last month that was pretty strong tightening of lending policy by banks. But for me the question is, and I'm not sure to what extent that was because of tightening of regulations that are focused on increasing the standards of credits and recognizing creditworthiness of clients. Assessment, standards of creditworthiness assessment, and to what extent that was because of, let's say, worsening of economic situation, growing unemployment rate, and worsening prospects of growing disposable income of households. That is the question. Of course, we as institutions in banking supervision just closely monitor the situation, also in terms of to what extent the impact of regulations on the credit action, and we will revise it from time to time. And I think that this kind of revision will be at half of this year to make some conclusions to understand our instruments. I will talk about this later. Our instruments influence the credit growth in Poland.
Do you think that a marked reduction in credit growth in 2012 will be one of the big factors in a potential slowdown in the growth of the Polish economy this year?
You mean the
consumer loans are being the restrictions on that? You've got housing loans.
Because on the other hand, we've got pretty good credit growth in terms of enterprises. So for me as a macroeconomist, so I think that from the let's say perspective to increase the potential growth of our economy, it is more healthy to deliver credits to enterprises and etc. than to, let's say, finance the excessive consumption. Of course, the question is to what extent the consumption, let's say, financing is excessive or not. I think that they will have some implication, but on the other we see that the private investment has been growing pretty rapidly at this moment. Of course, there's the question why, because of seasonal factors or not, but at this moment I think that this will have limited impact on GDP growth.
We've talked about the macro picture and a little bit about commercial real estate, and we will return to that. We haven't touched at all on an area which is slightly to the side of that, but the residential property market. And I've asked Paweł Grząbka, who's from both the Adam Smitha Research Center and also the CEO of CE Property Group, which looks more at the residential side of things. And in light of what we've heard about a tightening of lending requirements and more of a reluctance of banks, especially in the housing side of things, to lend, what impact is that going to have on developers in this year, and then on the end buyers? I mean, are we going to see? I was at a conference a while ago on looking at the residential real estate market, and the trend seems to be sort of flat to down in basically every large Polish city. Do you see the same thing?
Thank you for the question. Obviously, residential market is very different from commercial markets because of the volume of the investment. The single investment is much higher for the commercial real estate than residential. Obviously, the sellers, the investors are different. The entities, the buyers are different. Also, from the point of view of how much money it takes to buy a single unit in residential is much smaller than commercial. Obviously, residential market is also affected by the economic turmoil, the slowdown EU. As I understand, probably similarly to what's happening in the commercial market. However, it's very interesting to see, or maybe to look forward, how the situation will behave in the near future. What was very interesting in 2008 was when the housing crisis started in US. Many people, including myself, thought that there will not be a very direct impact of the situation in Poland because of the very different structure of the housing market, and huge geographic distance. What we saw is that the impact of what's happening in very far markets is very significant on the Polish market, and it will be very interesting to see how the situation will evolve in Poland. On one hand, and what was mentioned here before is whereas Poland still notes very good economic results, and we see slowdown or the potential depression in selected EU countries. Poland very good numbers seem to show that Poland is more and more like a bright star among the other countries. That would possibly mean that many investors from other countries would be attracted by this bright star and would come with the money to the Polish market. So that's the one view of how the situation would look like. On the other hand, and what we saw in 2008, 2009 is that turmoil and crisis in other countries, with still relatively good economic data for Poland, still resulted in really slowing down or halting many of the investments in real estate in Poland. Yes? Although the situation in Poland from the macro economic data was very different, although the demand for the real estate, for residential real estate in particular, is very different. And still, we saw dramatic decrease of the investment on the supply of the residential real estate, and also the demand for the real estate. Putting aside the reasons for the slowing down of the supply, focusing on the supply part of the residential real estate market, we saw that many of the financial institutions basically recommended or basically ordered the Polish bank branches to limit the exposure to the real estate market because of the situation what they have seen in their local markets, either in US, France, Germany, or some other countries. So the fact that the Poland economic data is rather positive versus the Western economies does not, for me, automatically mean moving large parts of the funds into Poland, because I'm afraid that many of the financial institutions, they would rather limit their exposure to real estate as a whole, rather than moving the money from the countries where there is a economic crisis to countries like Poland, where the economic situation is much better. Obviously, we might say that the Polish institutions are separate entities from banks in all other countries, but it's also true that 70% of the assets, if I remember correctly, in Polish banks is owned by financial institutions in other countries. And obviously, Polish banks are the separate Polish entities, but in their supervisory boards, representatives of the mother companies, and they see their situation in Germany, in France, in Benelux countries. They see how the real estate market, how weak is the real estate market in their countries, and they would be much more willing to say the Polish market, okay, maybe it's good in the short term, but in the long term, I see no reason why it will behave much differently than the one in Germany or the Netherlands, Belgium, or Denmark, for example. Yes? And therefore, they would be rather willing to be more cautious and recommend limiting their exposure to the real estate market, rather than saying, since it's performing badly in Western Europe, let's move the money to Poland.
So you don't think you'll see any kind of a safe haven effect that as people get pushed or see grim conditions in Western Europe, that they will run
I would be the first one to say, let's move the money, let's keep it here, because I strongly believe in the potential that the Polish economy has. But looking back at what happened 2008, 2009, Poland was the only country in the whole EU with the positive GDP. Did it have any significant effect of moving the funds from the Western countries into Poland, the real estate? I haven't seen that, and I'm afraid that might be the same rationale in the near future.
Good. Thanks very much.